Welcome to Jimmy on the Saddle, episode 8. My name is Jimmy Cho. I'm a realtor at EXP in Los Angeles area. As we discussed in my previous episode 7, the real estate market has been so hot last few years. The historic low rate helped home buyer and investor with low monthly payment. As a result, the price of property went up so much and refinancing market has been crazy. However, the things might get changed. The foreclosure moratorium is ending soon, and there are 3.6 million homes in mortgage forbearance program right now. What makes more gloomy is the unemployment rate is still very high. So there will be less and less people who can afford to purchase a home in upcoming year. This will eventually drive the price down. So I think it's wise to get ourselves ready for a buyer's market in next couple of years. Here I'm with Nathan Kwak. He has been a mortgage loan officer for a long time. Let's hear how we need to prepare ourselves through a lens of financial perspective. Hi Nathan.
Hi, how are you?
Good, how are you?
Good.
Thank you for accepting this interview.
No problem.
Could you briefly introduce yourself?
My name is Nathan Kwak, and I'm currently with Lending Plus.
Nathan, we have a lot of audience who are interested in purchasing a property in next couple of years. How would you advise to them how we prepare ourselves to purchase property?
Let me start with what not to do and what to do when you prepare for the funds to use towards your purchase of your property. First of all, what you don't want to do is you deposit any cash, because all the funds that you are going to use will have to be either seasoned or sourced. What I mean by seasoned is the money is deposited as long as that had been set in the account over 2 months, so that those 2 most recent bank statements you will be providing doesn't show any deposit, then that fund is considered as seasoned.
Thank you. So we need to manage our fund that we are going to use. So it has to be either sourced or seasoned in our account for over 2 months.
Yes, that's correct.
My next question is, how do we manage our credit better?
Okay, how to manage your credit? The lenders, they pull your credit reports to see your credit score, but what is more important is what your monthly expense is, so that they can use that towards calculating the DTI, which is the most important factor to analyze your feasibility of the loan. And one of the way you can boost up your credit score is, let's say you don't want to have only one credit card max up the limit. You rather disperse those amount into several cards.
Are you saying that if we have the more credit card, is it helping us to get a better credit score?
Not necessarily. You might want to manage the number of credit cards as well. I talked about how to manage your existing debt, but on top of that, when you are thinking about purchasing the house, I strongly recommend that you don't open new credit card accounts, even you don't want to make any credit inquiry. The reason why I'm recommending not to open new account is because $20,000 loan amount will be depending on your $100 monthly expense. Obviously, if you open a new credit card, you'll be using that, and that most likely that will entail your spending, and that can negatively affect.
Wow, if we spend $500 on our car, that will negatively affect $100,000 on our loan amount. Is that what you're saying?
Yes, if you have like a recurring monthly expense, let's say you said $500, yes, of course.
Nathan, you said DTI ratio is the most important factor to determine if our loans will get approved or not. Can you explain a little further on DTI?
Of course, DTI, D means debt, 2, I means income. There are 2 kinds of debt. One is property related debt, and one is the monthly expense that is seen on the credit report. What I mean by property related expenses, your monthly payment, your property tax, and your yearly insurance premium divided by 12. And some cases the property has monthly HOA dues. Those are included as well. And there's one debt category, and the monthly expense that is seen on the credit card, that will be the second category of the debt. And these two debts combined is considered as the debt in that DTI ratio.
What's the DTI range that we need to keep for the approval of the loan?
That actually depends on the programs. The DTI ratio normally ranges from 43% to 49.99%. Let's say if the program requires DTI of 45%. That means, let's say your monthly income is $10,000. That means your combined debt, one debt from property related and those monthly expenses that is shown on the credit card, those combined debt cannot exceed $4,500. That is 45% of $10,000. That's how the DTI is calculated.
Nathan, there are two types of income owners. One is from wage and the other is self-employed people.
Yes, actually there are a variety of incomes like rental incomes and all that. Two major types of income is self-employment income and W-2 wage owner incomes. Let me talk about W-2 wage income. For W-2 wage owners, the lenders see the gross income. The gross income is the income of the borrower, as opposed to net income is considered as income for self-employed income. For self-employment income, if year 2 income is higher than the year 1 income, then they combine those 2 years, divide by 2, and the average will be your net income. If year 2 income is lower than year 1, then the lender will see your year 2 income only.
Does lender require how long that we have to work at each business?
Rule of thumb is 2-year employment history you need to show. You can actually switch jobs in between as long as continuously, if you worked 2 years, that income can be used and that you are qualified for W-2 wage owner.
So for example, if I have a business, I just opened up last year, I don't have 2 years income record, what do I need to do?
Actually, there's nothing you can do because you have to have minimum of 2 years tax return you need to provide. And on top of that, I forgot to mention this when I explained the self-employment income. If the company is established 5 years or before, then the lender requires only 1 year tax return if you go with Freddie Mac program.
This is my own case. Me and my wife has a credit card together. I'm the main account holder. She is a co-signer. In her credit report, that account is showing as her debt.
It doesn't matter because as long as any liability comes up on her credit report, that is considered as a monthly expense. Remember, if you have $100 more expense on your credit card, then your loan amount will be $20,000 less. So when you do the co-signing for other people, you gotta be really, really careful.
Nathan, thank you so much for your time and all those information that you shared with us.
It'll be my great pleasure if it helps by a little.
Yeah, let's give him a big hand.
Thank you.
Thank you so much.
Thank you.
So I'm going to put his contact information. So if you have more inquiry, please feel free to reach out to him, call him or email him.
Please do so. I'll do my best.
Thank you very much. Bye
Thank
bye.
you. Bye.